Hello and welcome to IG's Trading the Markets podcast. This week we're here to talk about the UK property market and the fallout from Covid-19. British Land reported a £1.1 billion pre-tax loss today. Its retail portfolio was hit hardest as e-commerce weighs on its bricks and mortar business. Despite this, the shares are rallying sharply in today's trade. Joining me on the podcast today is Ben Habib. He is the CEO at First Property Group. Ben, great to chat to you as always. Now, I know obviously you're invested in the commercial side, but let's talk a little bit about retail, if you don't mind, because it's just interesting to hear about these earnings today from British Land, which on the face of it look pretty bad, but investors somehow are reacting positively. What do you think is going on?
Yeah, well, I think it's a function of two market forces working in opposing directions. The first market force, which is the obvious one, is that retail property is under enormous pressure. It was under pressure even before the COVID crisis kicked off, with internet shopping stealing its market share, as well as, changing social habits and so on, as well as large business rates being levied on retailers, minimum wage hitting them. They were in a perfect economic storm even before the COVID crisis. But obviously, with the COVID crisis kicking off, they've been prohibited from trading. So, you have an absolute collapse in the retail sector at the moment. And that's one force. But the other force, which is the interesting one and in a sense defies gravity, is asset values rising, as evidenced by the share price of British Land. And this is something we have seen before. And we had it for many years after the first financial crisis in 2008, when interest rates collapsed and, central banks across the globe started doing QE. And the net result of QE and ultra low interest rates, very loose monetary policy, is a bolstering of asset values. So I think what you've got here is people recognizing that whilst British Land's retail property may have been hit quite hard as a result of the COVID crisis and all the other trends that were adversely affecting retail, actually asset values are going to be underpinned in the medium to long term because of this ultra loose monetary policy, which is now, I think, here to stay for the foreseeable future.
Do you think that makes sense, though, the fact that it is those low interest rates and the loosening of monetary policy that has pushed up asset values, rather than the reality that a lot of us are seeing in terms of the fact that shops are essentially closed and other parts of the property market are taking hits as well?
Yeah, well, I mean, trying to make sense of the way markets work is a wasted bit of time, frankly. Even before the COVID crisis, we saw WeWork. I don't want to pick on WeWork necessarily, but it's a very good example. A company that was losing money hand over fist was until recently being ascribed astronomical values. And that was even before this latest monetary easing. And we saw Uber being ascribed massive values. Apple, that's a proper business, of course, it's profitable, but it hit $1 trillion market value. Amazon, again, another very profitable, successful business, but again, hitting $1 trillion market value. Are any of these values sustainable? I think to the man on the street, they're not. But the fact is, when central banks cut interest rates the way they have, when they're prepared to print money and pump it into the market, then real assets, and property is a real asset, goes up and they go up in value.
So when we look at the retail sector, obviously it's taken a massive hit from COVID-19, probably one of the hardest hit in terms of all of these sectors in the economy. But given the fact that the government guidelines are now changing and shops will be reopening next month, do you think that's going to help revive the retail sector? You mentioned that there were negative trends underway within the sector already taking place aside from COVID, and that the coronavirus has just expedited that process. To what extent is the guidelines and the reopening of the economy going to help to restore normality in terms of the retail sector?
Yeah, well, I don't think it's a one-size-fits-all kind of response to your question. I think different parts of the retail sector will respond differently to what comes in the next few months. We've already seen, for example, supermarkets and actually going largely unrecognized for the contribution that they've made to the nation during the course of the lockdown. But we've seen supermarkets doing a fantastic trade, being the only ones open, being being effectively the retail backbone of the United Kingdom, feeding the United Kingdom. And so I think you might see more interest in supermarkets and understanding the resilience and core importance of them to the country. We've also seen discount retailers that have been able to remain open doing quite well. And I think those that reopen in July, when they're allowed to do so, I think they will do well as well, the discount retailers, because we will be mired in a deep recession. But there will be other retailers who will continue to be hit hard. And without wishing to name names, the middle fashion sector is going to be hit very hard, I think, again. Shopping centres are going to be under pressure again. Leisure isn't going to open up for a while, and that's a key component of the shopping centre offer. So I think they're going to be under continued pressure. So it really depends on which part of the retail market you're looking at. But as a whole, if you were to generalize, then I think the pressures generally on retail are going to continue.
Okay, let's talk a bit about the commercial property market then, because it's been interesting to see this major sea change in terms of how people have been working in the last couple of months. All of us really essentially having to adapt to working from home. Been an experiment, and it looks like in the most part it's been a major success because of a lot of technologies like Zoom. So, I mean, what does that mean for office working? Do you think it's a thing of the past?
I've been now in property for coming up to 30 years. And ever since I've been in property, people have been talking about the demise of the need of formal office space and how everything should be sort of much more flexible. And when the internet first arrived, everyone thought that would be the death knell of offices. But actually, I don't think the COVID crisis is going to be the ultimate death knell. I think that there's nothing that substitutes good face-to-face contact, brainstorming, and so on that takes place when you meet people, and that can only really take place in an office. So I think there may be a continued move towards some office functions being off-sited, as it were, and being capable of just being discharged from home. But the need for an office, the need to communicate with your peers, the need to brainstorm, the need to actually, for bosses, simply put, to keep an eye on what their staff are doing, that need doesn't evaporate. So I don't think it's the end of offices. Actually, what we might see, because of the need for social distancing and therefore a push for greater areas required for a given number of people, we might actually see demand for office space rising, paradoxically.
That's really interesting. I mean, talk to us a bit now about your business. What are you doing right now? Are you sort of on the sidelines in terms of your investments, or is this whole sort of change creating fresh opportunities?
Well, we're very lucky, or extremely prescient, depending on how you wish to look at it. But we sold a significant property of ours back in week exchange contracts in December, when we completed the sale in April, and that gave us £25 million of free cash. So we've got on our balance sheet £25 million of cash waiting to be invested. Our funds have uninvested commitments of around 100 million. So we've got we've got a lot of buying power with us at the moment. And we think the markets are going to take a dip. Probably not yet. I think the dip is going to be worst when recession hits the country for proper. And I think that's not really going to happen. People aren't going to experience the recession until September, October time, when the furlough scheme is removed. And I think that would be a very good buying opportunity from September through till sort of March next year. But then I think we will see the benefits of ultra loose monetary policy buoying markets and asset values rising again. So I think the window for buying assets won't be that long, and perhaps that's surprising because the depth of the recession is going to be severe. But I think the window for buying assets won't be that long. And probably by March next year, you'll start seeing asset values rising. And so, we're ready to invest. We're not investing at the moment. We're ready to invest. We've got the resources to do it, and we'll be looking very eagerly at the market over the coming months.
Yeah, and I know you're invested in properties in Poland. We know that Eastern Europe suffered a lot less from the coronavirus than the west of Europe. Has that been reflected in your investment?
We've been very fortunate again. Most of our balance sheet, stuff that First Property Group itself owns, and has co-investments in, is located in Poland. Poland has had a very good COVID crisis, if you can describe it like that. They were early to lock down. They've been early to lift restrictions. So shopping centres, for example, in Poland opened on the 4th of May. They have social distancing policies in place, but the economy is again trading. And the other great thing about Poland is that they started this crisis with relatively low government debt levels. So they went into the crisis with government debt as a proportion of GDP being below 50%. And even if GDP shrinks a bit, which it will, obviously, because they're going to have a recession just like everyone else, the stimulus that their government's given to their economy, which equates to about 10% of GDP, will still leave them with a lot of government spending headroom. And they won't have to go into negative interest rate territory or to indulge in QE in the same way that we will have to in the West. Funny enough, they've done a bit of QE. I don't think they needed to do it. They have done some. I think it'll be very limited. But I think we will see Poland recover faster and quicker and be in much better shape than Western European economies.
All right, Ben, thank you so much for sharing your insights with us today.
Thank you.
That was Ben Habib, CEO at First Property Group. Thank you so much for listening to our podcast, IG Trading the Markets. I'm Victoria Scholar, and don't forget to subscribe.